Hello and welcome to Chapter 10, Understanding Financial Statements from the Introduction to Business textbook. Financial statements is a really key and central part of a business. Without having sound financial structure of a company, no banker, no investor, no anybody who wants to provide you some type of loan is going to take you serious. Two of the top key things if you're in a business plan competition that they're going to look at is your financial statements and your executive summary. So looking at your financial statements, you have to understand the common language used in financial statements. You don't have to have a CPA in order to understand the financial language, but you have to, you can use just some basic knowledge, and this is one of the key things that you can do to understand the common language used in financials. So one of the things that the textbook talks about is the baseball diamond analogy. When you're looking at home plate, when you're up to bat, right? That's of course, you're looking to raise money or capital to start your business. So how much money do you need to raise capital, or use your own money to invest in it to start your company? When you get to first base, right, it's to buying the assets that you need to operate the business, whether that's just a computer, whether that's machinery, whether that's t-shirts, whatever it is that you need to operate the business. Second base is, of course, to generate the sales of the revenue through your operations. The third base is paying all of your expenses that you earned through profit. And then getting back to home base, right, after you've hit your home run or you hit, line drives, is the profit becomes part of the equity, completing the cycle. So one of the first things you have to understand in financial statements is called a balance sheet. The balance sheet determines as to how much assets and how much liabilities and equity a company has. The assets, of course, is all the stuff that the company owns: cash, inventory, equipment, and other assets for the company. The other side is the liabilities and equity, all of the debt you have, all the equity that you have from the company. So just because you have an equipment, if you still own debt on it, it is considered a liability. But of course, the equipment can be an asset to your company because you can hopefully sell that that equipment, and of course make cash on that. So how quickly can you turn an asset into liquidity, meaning liquid into cash? Of course, here is the accounting equation. Your assets equals your liabilities plus your equity. The capital structure, the mix of debt and equity, that funds and company operation is called the capital structure. So what the balance sheet really does for a company, what it does, it gives us a snapshot, the point in time and frame of what the company owns and what it owes. Not in specific any period in time, but just what it owes and what it owns. And of course, we have an example of the peanut roasting, right? If they ask for 3K in capital, and of course, which allows them to purchase a cart and some inventory, and they keep $750 in cash. Again, we'll talk about this lecture video is that you'll learn that in business, cash is king. That's one of the important parts you have to learn. Cash is king, and without cash, it's very difficult for a business owner to move on or to operate a business. The other important financial part that you have to know about is the income statement, or in other words, the profit and loss statement. And what that shows is during a specific period in time is the flow of resources flowing through. So at the very beginning, let's say, for example, you're a pizza shop owner, right? The sales revenue. So let's just say, for example, you sold $10,000 worth of pizza on a Thursday night. Let's just give an example. So that's your sales revenue. Now, all of the cost of goods sold. So all of the direct costs that was related to selling the pizzas, the pizza boxes, all of the ingredients that you had to do, right? Some of the direct costs of goods sold, the gross profit. So after all the sales revenue, right, minus the cost of goods sold, that's your gross profit. Now, of course, you have to minus all of the expenses that went into it. So you know, if you're renting a space or you're leasing a space, the rent that cost there for that night, the, you know, if you're paying off equipment still, the salaries, the delivery drivers, all of those expenses that you have to do. Then at the end of the night, how much net income did you make? You can make $10,000 in sales, but at the end of the day, after all of the expenses that you did, what is the net income? So what is the gross profit? You know, the gross profit minus all of the expenses is your net income. It's just like, take it for example, your paycheck if you work, right? So you may get paid, let's just say $300 a week in gross profit, but after taxes and taxes and all that, what's your net income? Same thing in business. You have to understand expenses, right? Operating expenses. What does it cost to all of the costs that incur to run your business, right? You have to pay wages, you know, the rent or the lease of the space, utilities, and other day-to-day expenses. Interest expense. So if you borrowed money, you have to pay the interest on that borrowed money. There's depreciation and non-cash expense, right? Of course, the assets that lose value as they age, right? Equipment, say for example, the pizza shop owners we go, that equipment loses its value as they age, just like a car. Once you drive it out the lot, it loses its value. Same thing with equipment, it loses its value as it gets older. Taxes, right? You have to pay taxes. You have to pay federal taxes, state taxes, income, local taxes. And the third important statement to know is the cash flow statement. So at the very beginning, you can have the cash on hand. So let's say, for example, you have $5,000 in cash on hand. And then, of course, you look at all the things you have to do, operating activities, investing activities. So again, anything you've gotten, the purchase and sale of assets, and of course, financing activities. So if you had any loans that you had to do, at the end of the day, how much cash do you have on hand? Again, cash is king, and it's important to have cash on hand. You don't want to operate a business with no cash on hand. So again, learning what a balance sheet is very important, because that signifies what the financial position of the company is. How much you have, how much you owe, and how much you own and owe. Then the income statement or the profit and loss statement, how much revenue and expenses are part of your company. And the cash flow statement is how much cash you have on hand. What's the cash movement look like? There's some other financial ratios. There's a lot of financial ratios out there, but one of the important ones is the profit margin, right? So what's your net income divided by sales? Shows how much profit is earned from each dollar of sales. You want to make sure you have a high profit margin. And one of the great ways to show profit margin, if you ever watch Shark Tank, Mr. Wonderful, Kevin O'Leary is really, really good at highlighting the profit margin for a company owner. So if you are producing a product and you're making a very low margin on profit, then it's not good. So for example, if if it costs you $5 to make a pizza, right? You want to at least increase that price by 30-40% or more, markup, have a high markup, because you have to realize you have to pay for the ingredients, you have to pay for the people that make that pizza, you have to, pay for folks to deliver that pizza, or even if someone's going to pick it up, there's still some expenses related. So you want to have a good profit margin on your product. And also it gives you a way to give discounts. Say for example, and I'll use another analogy, say for example, you make baseball bats and it costs you $75 to make the bat. At the end of the day, it costs you $75 to make the bat and deliver the bat. If you sell that bat, it costs you $75, but you only sell the bat for $90, you have to, and then of course you have to minus the expenses that goes into marketing it, the expenses that goes into selling it, and you have very to little no margin of giving a discount. But if it costs you $75 and you sell it for $299, now you have some room to give discounts, perhaps give a salesperson a little bit higher of a commission to sell that bat, and so you want to have a good profit margin. The equity multiplier, again, assets divided by equity, and the asset utilization, sales divided by assets. Profit margin, again, is very important, one of the most important parts. So like, you want to make sure you have a good profit margin, is so for how much profit is earned for each dollar of sales. And the return on equity measures the return earned on owner's investment. So if you invested your own money, how much money are you getting back? Here's just the return on assets and the formulas that you can look at, the return on assets, just to look at it more in depth. If you're falling into financial troubles, that's why it's very important to look at your financial statements. If you want to improve your financial performance, either increase sales, right? Improve your marketing, get the word out more, develop new products, expand into new markets, or charge more. Reduce expenses, reduce things that you don't need to spend money on, reduce that waste. Optimize your assets, or adjust your capital structure. So again, here looking at the Jersey Shore ice cream, again, you can make annual sales of $168,000. But again, what is the cost of goods sold and all the expenses that you have, right? Including the wages. So at the end of the day, you can have $168,000 in annual sales, but after all of your expenses minus $119,000, again, how much profit margin are you making? So you have to think about those things. So again, some of the important key takeaways that you have to understand is financial statements are connected. Every single part works together. Balance sheet, income statement, and cash flow together tells the story of the company, right? The financial story of a business. The better you understand those three financial statements, and you understand the common definitions of all those statements, the better you're off to tell the story of your business to an investor, to a banker. If you don't understand your own financials, then a banker is definitely not going to understand or see all of the wrong all the wrong things financially of your company. Cash is king. I cannot stress that enough, and I've said that at the beginning. Cash is king. But a business can be profitable, but if there's no paper trail, if there's no cash on hand, there's going to run into some problems, and you're not going to be able to weather difficult periods. I remember getting a phone call once from an individual, a business owner, frantically looking for a business loan, and she was telling me that she has to fulfill 500 orders of her product, but she has no cash on hand to produce those products. And the customer was hounding her on these orders, and she was on the verge of putting a lien on her car in order to fulfill those orders, those 500 orders. So again, I don't know what happened to the business owner in terms of where it went wrong. How come there wasn't enough cash on hand to fulfill those orders? Maybe the business owner took too much on than she could handle. I don't know the full story behind that, but what I'm telling you the story is because you don't want to run yourself into a situation where you have all these orders, but you don't have enough cash on hand to fulfill them. Again, going back to the baseball diamond is a really good use of knowing how your financials work, right? From the very start of home base, how much, starting your business, then of course generating sales and the cost of goods sold and how much it costs, and of course your revenue, and all that good stuff. So again, balance sheet, income statement, and cash flow is a very important part of your business. Learn those definitions, learn what it does, because you have to be able to tell the story, your financial story. And that wraps up chapter 10, Understanding Financial Statements from the Introduction to Business textbook. Thank you.